is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Rebutting the rebuttal, Hindenburg says Adani's 413-page response to its allegations fails to answer most questions. The rout in the group's shares hits $71 billion and bonds slide. Fragile sentiment, stocks and futures fall as investors weigh Adani's plunge, China's reopening, and a mega week for central bank rate decisions. Plus, London's future as a financial hub. We discuss fintech and the city with Anthony Jenkins, 10x founder and former Barclays chief executive officer. Now, we're getting some breaking news for GDP in Germany. Preliminary fourth quarter GDP falling some 0.2%. It's a little bit worse than expected. Quarter on quarter, the estimate was of no change. The picture adds to uncertainty about the European economy. We also had that inflation print in Spain earlier on. Of course, this could be an early indicator of what's to come in the rest of the Eurozone. The markets not really taking it in their stride. Shares in Europe declining. U.S. equity futures also declining. Now, there is a note of caution creeping in at the start of the week by interest rate decisions, also big companies reportings in the U.S. European stocks down 0.4%. S&P futures also down 0.7%. We look at sterling. Really, we also look at bonds across the board, not only in Europe, but treasuries on the back of that inflation print in Spain. The fact that the ECB could be more aggressive in their hiking. Now, let's get on to the European map to see if there's any material difference between, for example, the CAC 40 in France and the FTSE MIB in Italy, down 0.3% across the board. Now, let's get more on Adani. Short seller Hindenburg Research says the group's response to its report alleging fraud and stock manipulation has failed to answer most of the questions it posed. The stock and dollar bonds of many Adani Group companies have continued to drop after the lengthy rebuttal. Adani says the report is bogus and unresearched. Let's get more with Bloomberg's conglomerates reporter, PR Sanjay in Mumbai. So Sanjay, what are the key features of the rebuttal from Adani?
So this is like pretty long, rebuttal of 413 pages, which landed up around late night on Sunday, and largely they were saying that this report is like ill-timed. It had mal-intention to derail the FPO, which is follow-on public offer, which is seeking to raise $2.5 billion from the market, and the follow-on issue is concluding tomorrow, and it has landed exactly on 25th. And they are saying the key allegations were like Adani clearly said that most of the allegations were like actually cleared. They've given in the public disclosure, and out of 20 questions, 16 are like baseless allegation, and they've also said that it's addressing its debt concern by deleveraging and raising equity from the market. And some of the concern which they said this Hindenburg research report is ignorant about Indian laws and Indian regulatory framework. And Hindenburg research as a counter in the morning, they said you can't put bloated nationalism in front of any report to evade questions asked by Hindenburg in their 100-page report. Clearly, Adani said these allegations are against not only Adani but against India growth story, putting India ahead of this kind of a rebuttal thing. So now it's getting a tale of rebuttals, like one rebuttal after a rebuttal. So story is evolving. It's a developing story.
It seems, Sanjay, it seems to be getting pretty ugly, and actually the rebuttal did not help with the sell-off.
Yeah, $72 billion have been already eroded from market cap of Adani Group of companies, and most of the stocks which actually gained in the first session, reversed, and it's now back in red. And most of the stocks are now, in red, and one will have to wait and watch because tomorrow is the last day for FPO, and still, interest was like very weak for even HNI and retailer. So, but company sources telling that HNIs are very keen, and towards last day they will be investing, and after HNI's retail investor will also pick up, but one will have to wait and watch.
Thank you so much, Sanjay. Bloomberg's conglomerates reporter, PR Sanjay in Mumbai. We're also joined by Anna Stupnytska, global macroeconomist at Fidelity International. Anna, thank you for joining us. A lot of the focus, of course, this week is not only on central banks, the Fed, the ECB, the Bank of England, but some of the earnings going forward. Has there been too much optimism that a lot of companies can hold on to their margins?
Yes, we believe so. It has been long coming, but we do think that it's this earnings season and perhaps the following earnings season that will put pressure on equities overall, and that pressure from the multiple shocks that we've seen over the past year, over the past few years, will finally show up in the earnings.
And what does that mean for inflation going forward? So, for example, in Europe, if we take region by region, we had that higher than expected inflation print in Spain. This could be a precursor on things changing in the Eurozone as a whole. Is that how you're taking it?
I think inflation dynamics are a bit different across countries. So if we talk about Europe, inflation seems to be a bit less entrenched than what we're seeing in the US. It has been driven a lot by supply side distortions. So even on the core side, for core inflation, there's some pressure from demand side as well. But we do think that the European inflation will decline faster, particularly from the second quarter of this year, than that in the US. But the Spanish print this morning is for sure a signal to central banks that they should not be taking for granted even a couple of successive declines, readings of inflation. Because inflation is sticky, there are factors that will continue putting pressure, like the labor market across the board, which might be weakening but still remains quite strong. And it just says to central banks they should not be pivoting before they're confident that the inflation has been tamed.
So there's a lot of talk or hope that actually Europe can avoid a recession. Is that still the case if inflation goes back up and the ECB needs to do more?
So we actually think that recession cannot be avoided in Europe or the US or the UK. Europe has avoided the long feared recession, obviously through the winter. We might still see some weakness. It might still be technical, but actually we are very much focused now on the policy-induced recession across the board. And that's about Europe as well. And that's why we believe that Europe will see a recession later in the year. Again, induced by policy, but also by the continuing energy shock that has been induced by the war, because these are all the shocks that are still in the system. As central banks, as the ECB continues to protect their own credibility by fighting sticky inflation, growth damage will show up. We think it's going to be very difficult to avoid it.
Anna, when you look at some of the difficulties facing inflation, or how you measure it, is there something that you look at to give us an indication, or is really that Spain figure it?
Of course, we'll look at different indicators of inflation that central banks also like and focus on. And that is various measures of core, trimmed inflation, where those measures, they strip out more volatile components. These are all still pointing to quite entrenched core inflation in the euro area. And also inflation expectations, as you know, very, very important. And that's what the central banks are focusing on. It's a bit less of an issue in the euro area, but I think it is an issue for the UK. And potentially also for the US, as some of the survey-based inflation expectations are above target. And actually, when we look at historical relationship of what is important for actual inflation process, actually inflation expectations are very important. It's one of the most important drivers. So that's, again, something to focus on to try to gauge the central bank trajectory over the next few months.
Anna, what's your take on what we'll hear from Jay Powell later on this week? Is he going to sound dovish? Is he going to sound bullish? Or does he just need to walk that tightrope that is so very precarious for central banks right now?
Yeah, so much debate on this right now. Well, we think he's going to be hawkish. It just doesn't seem to us that there is any evidence right now or any incentive for him to suddenly pivot or to be more pragmatic. And I think one of the main indicators he's concerned about is financial conditions. They have eased. They've been easy, well, since the peak, they've been easing for some time. And that means that with all the tightening that they have done, some of that effort might be reversing in the markets. So I think it doesn't make sense. Data, yes, has been weaker, but the labor market remains resilient. On balance, it should be hawkish and trying to get those financial conditions tighter from here.
Anna, thank you so much. Anna Stupnytska, a global macroeconomist at Fidelity International, stays with us. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Spanish inflation has unexpectedly quickened, snapping 5 months of slowdowns, prompting traders to boost bets on ECB rate rises. Consumer prices advanced by 5.8% in the year to January, well above the 4.8% estimated by economists. The task of forecasters was complicated this month by a reweighting of the Eurozone inflation basket. Now, Israel say it may penalise the families of Palestinian attackers by revoking identity cards and residency if they do support violence. The warning comes after a Palestinian man shot and killed 7 civilians on Friday. That followed a deadly Israeli raid in the West Bank city of Jenin. The rising violence, making January one of the bloodiest months in years, comes ahead of a visit by US Secretary of State Anthony Blinken this week. Now, Rio Tinto has lost a highly radioactive capsule somewhere along a highway through the West Australian desert. The mining giant and local government are attempting to find the 8mm long widget, which is a component used to measure the density of iron ore. While the risk to the general community is indeed low, exposure to the substance could cause radiation burns or radiation sickness. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne Gerrans. Coming up, a crashing global chip demand is actually threatening earnings as another major chip maker is set to report tomorrow. We have the details next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, global chip demand has slumped, with the $160 billion industry suffering one of the worst routes ever, threatening to wipe out earnings. Key memory chip maker Samsung posts results tomorrow. Well, we're back with Anna Stupnytska, global macroeconomist at Fidelity International. Anna, when we look at the global chip industry, we didn't have enough of the memory chips, now we have too much. Is this a problem with the industry and the way it's done, or is it really a barometer of what kind of world economy we'll be left with?
I think from a macro perspective, from where I sit, this tells us that those supply chain disruptions that we have seen since COVID or due COVID are indeed unwinding. When we look at a number of different indicators, and some of them do include chip demand, chip supply, they do show that these restrictions are very easy now. And so that is feeding into inflation, absolutely, and our understanding of inflation, because it's the supply side components of inflation that they have been driven by the supply side disruptions that are easing and will probably be easing faster than those on the demand side. And so, yes, this tells us that we are looking to less inflationary pressure going forward from the supply side shocks.
And talk to me a bit about Japan. So we have a lot of experts, including a panel actually of experts coming out saying the Japanese government and really the central bank should revise this joint policy statement and make an inflation target a long-term goal. Is this 100% the way we're headed, and will this happen after Governor Kuroda steps down?
Well, as you know, a lot of speculation in the markets and consensus is, I think it will happen after Kuroda steps down. They will exit YCC and negative interest rates. And I would say, as a narrative, it works. And it's hard to disagree, because at some point inflation will probably be higher and will signal enough momentum for the BOJ to signal that they might exit the super accommodative monetary policy. However, we do worry about about the risks around that. As we know, the YCC in Japan has been the anchor for global yields for many years. The exit from this kind of policy is going to be exceptionally difficult, not just for the Japanese markets themselves, but we think also potentially the spillovers to the rest of the world at the moment are probably underestimated. So it's in terms of where capital flows, and we've already seen some outflows from Europe, especially going back to Japan, and potential market stresses. So we do think this is one of the risks to watch. The narrative makes sense, but its execution, I think, is very uncertain.
How's uncertainty for the Bank of England policy? So we have a big decision coming up. Is, Governor Bailey going to get it right, or is there a real danger that they overhike and that we're going to see an even longer and protracted recession?
I don't know if he's going to get it right, or depending on what he's aiming for. But looking at, again, the labor market and wages and inflation expectations, it makes sense for them to continue hiking and to be hawkish against the background of the economy going into recession. So again, it's about central banks protecting their credibility, fighting inflation that is sticky, and producing that growth damage. So again, we think it's likely that the UK will go into recession as it is fighting this very tight labor market, not just because, as a consequence of COVID, but also as a consequence of Brexit.
Anna, thank you so much for joining us. Anna Stupnytska, global macroeconomist at Fidelity International. Now, coming up, as Conservative Party Chairman Nadhim Zahawi is sacked from government, we'll bring you the latest on another turbulent few days in British politics. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. UK Prime Minister Rishi Sunak has fired Nadhim Zahawi from government following recent revelations over the Conservative Party chair's taxes. Sunak said an independent review showed, quote, serious ethics breaches. Joining us now is Bloomberg's Leanne Gerrans with the very latest. So, Leanne, this is another blow to Rishi Sunak's government, been in power only for 3 months.
Yes, he's coming up to his 100 days in the top job in Downing Street, Francine, and it's not looking so good, is it? Yesterday, we do know that, of course, Nadhim Zahawi was fired as the party chairman over these revelations about his taxes, which have been causing controversy for a fairly long time at the moment. And the Labour leader has said that the Prime Minister has looked really weak over this because he didn't fire Zahawi earlier when they did hear about this. Now, I just want to go into the fact that the Tory party chairman did acknowledge that he was careless with his taxes. And Francine, he actually paid over £5 million to HMRC, and this was all to do with the sale of shares in the company that he co-founded with his father, which is YouGov, which ironically, YouGov is a big polling company here in the UK, which we know, and that's showing that the opposition Labour Party is well ahead of the Conservatives in the polls. And I think this latest scandal is really not going to help Rishi Sunak when it comes to that.
So what does that mean for the economy? I don't know whether this is a distraction or this is a significant problem for Rishi Sunak's standing.
So this is a bit of a distraction. I think it's easy to put it that way, and a lot of the MPs themselves feel like that. Like Bim Afalami, one of the Conservative MPs, has come out and said it has been a distraction, especially away from policy, and at a time, Francine, when we've seen this country grind to a halt because of strikes. We've had ongoing strikes. It's difficult to get into work. The trains are on strike. Also, when it comes to the NHS, we've seen nurses and ambulances on strike. Well, Rishi Sunak has had to bat away allegations about Nadhim Zahawi. Also, Gavin Williamson, the Minister without portfolio, he also went recently, and that was over an ethics breach, into bullying. And now it looks like the Deputy Prime Minister, Dominic Raab, could be facing the same thing. So instead of getting into policy, we are seeing Rishi Sunak here having to battle things. And we know he didn't go to Davos. You were in Davos. And instead, the Labour leader, Keir Starmer, went along with Rachel Reeves. So Rishi Sunak's really been at home trying to shore up his position.
Yeah, I mean, Davos is probably also not a good look for the billionaire Prime Minister. So that's also probably why they stayed away. What does that... We actually also had optimism at a 6-month high. Very quickly. I mean, this is finally some good piece of news.
Yes, it is a good piece of news. So we have some optimism, and this is from the Lloyds Banking Group month. So Lloyds Banking Group. So they're saying that optimism is at a real 6-month high, and this is despite more signs that the economy is declining. However, on the other end of the spectrum, CBI warning of recession. So 2 different surveys coming out there today.
Leanne, thank you so much. Leanne Gerrans with the very latest on the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 in our half-an-hour special. Coming up, the British Chancellor Jeremy Hunt wants to turn the UK into the world's next Silicon Valley. How viable is that? This is Bloomberg. Hindenburg says Adani's 413-page response to its allegations fails to answer most questions. The rout in the group's shares hits $72 billion and bonds slide. Fragile sentiment, stocks and futures fall as investors weigh Adani's plunge, China's reopening, and a mega week for central bank rate decisions. Plus, London's future as a financial hub. We discuss fintech and the city with Anthony Jenkins, 10x founder and former Barclays chief executive. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The British Chancellor Jeremy Hunt has argued that leaving the EU can be a catalyst for prosperity for the UK. At a speech at Bloomberg's European headquarters here in London on Friday, Hunt vowed to attract the world's tech entrepreneurs and green technology firms. Now, he said his ambition is to turn the UK into the next Silicon Valley.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Here with us, Eileen Burbidge, partner at Passion Capital and UK Treasury Special Envoy for FinTech. Eileen, thank you so much for joining us. There's so much going on in the world of tech, and Jeremy Hunt definitely put that at the forefront. I feel like in the last 3 years, maybe the UK government has left tech to one side a little bit. Is it now a little bit too late?
I don't think it's ever too late, and it's better late than never. But I do think clearly the government had so many other priorities over the last few years that I think, I've been on a few times talking to you about the momentum that we had maybe 2015, 2016, when we had the coalition government, and a real emphasis on things like Tech Nation and other things. And of course, when I was appointed as Treasury Envoy. But I do think coming back to shine a light on the tech sector, especially when you're talking about productivity, skills, and the economy in general, is the right thing to do. The question is, where is the sort of detail, where's the meat in the policies to come?
So what's needed? Is it golden visas? Is it, I don't know, taxation? How do you make it work?
Yeah, I think there's a number of things. I think the first thing is probably to try and emphasize skills training both domestically and attracting skills from abroad. So to your point, I don't know if it's a golden visa. I don't know if we continue or expand the current global entrepreneur visa that we actually started here in this country a couple of years ago. But there clearly needs to be a lot more signposting about how the UK is welcoming to people coming from abroad, and also an emphasis on skills being taught more here as well.
Eileen, what does that mean for where the UK can actually excel at? So are you also having conversations with the Labour Party, given how far ahead they are in the polls right now?
I mean, we talk across government as investors, right? We're opportunists. And so we're going to speak to whoever might be able to influence policy for sure. But I think fintech is the right emphasis. And you've got Anthony coming on shortly. Absolutely. The fact that London and the UK has always had such a rich heritage of financial services makes a lot of sense to double down on and start to try and improve in terms of digital enablement. But there are so many other areas, such as education, such as the climate, such as actually just ways of working and everything else that we do so well here in the UK.
Is Brexit a help or a hindrance?
I'm not supposed to really probably go into too much. You don't have enough time for my opinion on that.
We have 3 hours. We're extending the program.
I don't think it helped. I think that As I said, I'm an investor, I'm an opportunist, so there's always opportunity in challenge. I think there are some things that could be done to probably make the most of where we are now. And I think it was a double whammy, frankly, with Brexit and then the pandemic. And so there's a lot of work to do to try and bring it back around.
Is there an area in fintech that looks especially attractive right now to invest in that the UK can also capitalize on?
Yeah, I think fintech is so broad, and that's what I'm excited to see, and I feel has been validating over the last 5, 6, 7 years. Initially, you saw a lot of fintech innovation on user-facing experiences, so retail banking, the likes of Monzo Bank, Starling, Tandem, even a Revolut, for example, even giving people access to other assets, whether that's cryptocurrency or other types of property investments and the like. What I think is really interesting as an investor now is going sort of further up the stack, as we would describe it, or deeper into the plumbing and the back end and what might enable enterprise financial services.
And that looks like what? So who's doing the right things? What are you investing in?
So there's a lot that's to do with what we call terrible labels. We ascribe to these things, but reg tech, so regulatory tech, compliance, KYC. Sounds really boring, really unsexy, but it's going to save, it saves enterprises so much money. It's really, really important. And we have the opportunity to probably, lead in the world here from the UK.
So this is basically the pipeline, right? That no one really, I mean, you say it's boring because no one really pays attention to it as long as it works. Who's that rivalry?
Who's that? I'm sorry.
Right. Is it a rival to someone? It's not.
I don't know
it's the back end.
Well, I think that any other destination in the world that has financial services heritage, so you could take Frankfurt, you could take New York, you could take Hong Kong, for example, they will all be seeing the same challenges, right? So we have trillions of dollars that actually get exchanged in London every day just for Forex. So that's why here in London, we should be closest to the problem and the challenge as well as the opportunities, but any other financial hub will have the same.
Is the UK struggling to attract talent because of the cost of living, or is that really a London problem? So are we going to see more hubs up north in the UK?
I mean, I think there's always been really great hubs in fintech, for example, Edinburgh, for example, up in Newcastle, up in Leeds, and so that's great. We should start capitalizing on that much more. We are closer in distance to those other cities here in London than, say, Silicon Valley is to New York, and that's one of the advantages and one of the strengths that we've had for the last few years. We do, again, need to double down on that. Having said that, you need to acknowledge that every single city and tech hub around the world has a skills shortage. It is not just here in the UK and just London, but it just means we have to compete even more.
Eileen, and I know we always talk about, some of the the Googles, the Facebooks of this world, and the Microsofts. We're seeing huge layoffs across the board. Was this downsizing because they just became too big? Does this make sense to you? Or is it a bit of a change and shifts for a lot of these companies?
Yeah, so I don't think it was a change in shift or a change in strategy or even an aggressive, about face. I do think there was a lot of hiring in the last couple of years coming off the back of the pandemic. And for example, when Meta announced its layoffs last autumn, actually the number of people it was looking to affect, or unfortunately, that would end up losing their jobs, equaled the same number of people they had hired between February and August just last year. So we're not even talking about sort of dialing back what had been happening over the last couple of years. At that instance, it was, let's look at what we did for the last 6 months, and maybe that represented, on top of everything else for the last couple of years, a bit too much optimism, and let's just slow things down a little bit.
But so it's not a change in direction?
No, I don't think it's a change in direction at all.
Some of the web services?
Not at all, not at all. I do think as soon as, we start to talk about inflation coming down, the sort of conversations about a macroeconomic, recession or global recession sort of going away or dissipating, the companies will continue hiring again, and even more aggressively, because they're competing with one another.
AI is all that everyone's talking about, partly because of ChatGPT, but also other applications. Yeah. Is it too late to come into AI right now?
I don't think it's too late. And again, there's always opportunities, whether you're going to be part of the infrastructure and the plumbing and actually the design, or whether you're going to be bringing interfaces into users and new experiences or new channels. So it's not too late. I do think with artificial intelligence, and something that the government has signaled they want to do, but we need to see the action, there's a lot to do with, I think, regulation or at least governance with respect to AI and ethics. We want to make sure that we don't have too many unintended consequences, and that's really important.
How do you make the difference? So one of the most interesting panels actually in Davos, and it was the most there were 2 oversubscribed panels. One was on chips around the world, and the other one was on AI, dark AI. So for example, costumes that simulate being shot, and the good AI, so some of the protein folding and things like that.
Yeah, and so it is hard to distinguish, right? It's sort of like, I mean, maybe this is going to sound too extremist, but, you know, it's a bit like when we first came up with the technology to build the atom bomb. You know, you have great power, great ability in order to affect change. I'm sure the people that are thinking about all the use cases now think about how it can help and what it's used for good. And we just need to think about, again, what the unintended consequences could be as well, and make sure we have governance and checks in place to sort of stop every once in a while and say, are we happy with how this is going, or how this could also be applied?
Eileen, as always, thank you so much for joining us. Eileen Burbidge, partner at Passion Capital and UK Treasury Special Envoy for FinTech. Coming up, don't miss our exclusive conversation with Anthony Jenkins. He's chairman and founder of 10X Futures Technology. We'll follow up, of course, on some of the FinTech that we were talking about with Eileen. He's on a mission to build better banks. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's carry on the fintech conversation. One-time establishment banker Anthony Jenkins is on a mission to upend the finance industry. The former Barclays chief executive now leads 10X Banking, a startup he founded to provide the technology behind everything from current account to loans. Now his ambition is to serve 1/10 of the world's population. Well, Anthony Jenkins, 10X Banking founder and chairman, joins us now for an exclusive conversation. Anthony, thank you for joining us. I mean, you've gone from strength to strength in terms of some of the offerings and backings and investors. Where do you see the most opportunity now in 2023?
Yeah, so if you think about financial services, the sort of mainstream players there, they haven't gone away. If you remember sort of 2015, everybody was predicting the fintechs would destroy the big banks. That hasn't happened. But what's happened is that the big banks themselves have come under increasing pressure. On the one hand, the fintech industry has defined a much better user experience, which the banks have to match. And on the other hand, of course, the big data companies are out there using data more and more effectively. So banks need to respond to that. And basically what I did when I left Barclays was I built all the technology I wish I'd had when I was running Barclays, because I never had the technology I needed to serve my customers, but equally more important to do that cost effectively and generate a good return on capital.
But is that still the case? So since you left, I imagine some of the big banks thought, look, we can do this in-house if we're going to have a competitive edge compared to our rivals.
Yep. So many banks have tried to do this in-house, but in reality, it's very specialized work. This is all we've done for almost 7 years. You know, we have a maniacal focus on making banking 10 times better. And so we've built a platform now where we can literally stand up the alpha version of a new bank in months. We did that twice last year in 2 different parts of the world. And so now we're providing an alternative for banks. Many will want to try and do this themselves, but they could also come to us. And I guarantee you they'll do it at 1/10 of the cost and 10 times faster than trying to do it themselves.
And Anthony, and this is, so your name doesn't appear in any of this, right? We also spoke to a company that opens accounts for most of the big banks, but no one knows about them. So does it makes banks, I guess, a commodity. Does it give them an edge using you, or is it like just back office?
What we do is we provide them with a toolkit that allows them to deliver great user experiences to their clients at much lower cost, and crucially use big data to make better decisions around marketing, credit, and so on. So it's a real competitive advantage, and the bank can focus on what they're good at, which is what customers do I want to serve, how do I serve them, what's my risk appetite, you know, what's the user experience, those types of things. And increasingly, I think the agenda's being set in financial services, not by banks themselves, but by other aspects of our lives. I mean, we expect our lives to work on our phone all the time, right?
I know, and all of our life is on our phone. I don't know what we do without our phone for even an hour. Anthony, what does that mean for cybersecurity? Is that your biggest concern?
Well, of course, everybody has to worry about cybersecurity. And it is a very high priority for us and, of course, for our clients. And the new world that we operate in, the cloud-native world, has many advantages around cybersecurity, because a lot of the old technology, you're talking about mainframes, which were set up 20, 30, sometimes 40 years ago, very hard to protect. But, you know, the banks have done a good job in protecting them. cybersecurity is an area where you need constant vigilance. You can never rest. You always have to be ahead of where the bad guys are going.
Anthony, I know your first investor actually was a Chinese company. Things have changed in geopolitics. Would it be much more difficult now for a Chinese company to invest in UK fintech?
Well, I mean, Ping An, who was the investor, wanted to set up a fintech fund, essentially. We were their first investment. And, obviously, the geopolitics has got more difficult. But they're looking around the world for great businesses like ours, and, I'm sure they'll continue to find great opportunities for them. Is
there a part of the world that you're most interested in, that either wants your services or also just wants to be an investor? Yeah, exactly. So, I mean, Asia continues to be a great growth opportunity for us. It's still underbanked, even though there are many banks there. It's got a fast-growing, relatively young population, so that's a big focus for us. And we have some clients in Australia that gives us a bridgehead. We're also working in Africa. We think there's opportunities in Africa, but mainstream Europe is also a good opportunity for us because many of the banks there have the same challenges. And what we've realized is we only have to build it once. We build it once, everybody can use it, and they all get the advantages of that. I remember in many of our conversations through the years, you've always been warning about automation hitting a lot of banks across the world, and now we're seeing a lot of job losses at Wall Street banks. Is that coming, or is it just because they were too big? They had hired too much in the last 2 years? Well, there's always the cyclical and the structural, right? So I think what's happening on the Wall Street investment banks is probably more cyclical than structural. But if you look at what's happening in retail banking, branch closures, there used to be tens of thousands of people who worked in branch networks for big banks, not just here, but all around the world. And those jobs have just gone away. Why? Back to what you said before, because we do our banking on our phones now. So what are some of the pitfalls? I know you worked, I think JP Morgan, we saw Goldman Sachs, trying to get into that digital retail push. You see a lot of these big banks from all angles. Like, is there a common mistake? Is there something that, Goldman Sachs shouldn't have gone into? We always say that this is about finding what we call a 10x shaped problem, and that's a bank that wants to do something that isn't just marginally better, that is on some level transformational, and crucially has the support of the very senior leadership in the banks. I mean, this is not unique to banking, right? You look at the incumbents in any industry, they always struggle. Why didn't Blockbuster, build its own Netflix? It had massive resources, it could have done that. Why didn't Kodak roll out digital photography? It invented it, but it didn't. Most of this is to do with cultural issues, politics inside the banks, where the economic center of gravity sits. And so the essence of this type of work is really to find leadership teams in banks who recognize that they have a great opportunity if they take a more adventurous approach to solving the problem. But how do you make sure that you're not living a Kodak moment? If you're a big banking chief executive, there's always a danger that there's a big trend that passes you by and you don't seize it. Yeah, so this is where I think the critical thing is now to get in the game, because this is all about building the organizational muscle that allows banks to transform themselves over time. It's a different way of operating. There are tens of thousands of people in technology organizations in banks working with quite outdated technology. That needs to change, and that needs to be led from the top. Anthony, when you look at the UK, so we had the Chancellor here at Bloomberg on Friday talking about the UK and especially London as a future for fintech. What does the government now need to put in place to make your job easier? Well, I mean, it always comes down to infrastructure, skills, access to capital, and regulation. Those are the things. Now, I'm a huge supporter of the UK in this regard. I think we often sell ourselves short in terms of what we've been able to achieve in the technology space. But there are many opportunities in front of us, and we just need to create the conditions to go and seize them. So let me give you an example. I know flexible working is controversial, right? But actually, in my business, I'm able to employ people all around the UK, and I can employ people in the areas that are relatively deprived, that people want to level up. So why not incent companies like mine to hire people in those areas? I don't need to go and set up a whole office there. I just need to go find folks But through what? So is it tax breaks? Is
Yeah,
it
some sort of tax break, some sort of incentive to do that would be very helpful. I think that would allow us to shift the centre of gravity away from places like the UK, Oxford and Cambridge, places like London, Oxford and Cambridge, Manchester, where we've already got these concentrations. So we could move jobs. We don't have to move businesses. We can now move jobs. That's one of the great opportunities. The other thing that I'm very excited about is this whole idea of how do we save households energy? And that's really a three-pronged challenge. You've got to be able to create a supply chain of kit that sort of insulates homes. You've got to have people who can install that stuff. But most importantly, there's a fascinating financing opportunity there because the payback on these things is long. So you need to be able to finance it. But of course, people move house. So why should I spend money insulating my home if I'm going to move in 3 or 4 years' time? So again, we could create some regulation around that, possibly link it to, say, council tax, where you might pay a bit more to council tax, fund it that way. Capital markets would put money on the table to, securitize those sorts of assets. So there's a lot of things we can do. We do need to double-click down a couple of levels, though, and get into what's really going to...
It's always the detail.
Exactly. What are we going to do different to make this happen?
We're seeing huge layoffs in tech, in big companies. What does that mean for your business?
Look, I mean, I was in the States in the late 90s, early 2000s, right? Everything, has these cyclical bubbles. Yeah. Companies go out there, they hire a lot of people, and then they recognize they've hired a few too many, and then they have to lay them off. Now, that's terrible for the people affected, don't get me wrong, but there's still huge numbers of jobs in tech, and the demand for jobs in tech is always going to be there. So I actually think that these sort of downswings in cycles are better for businesses, because when you're building a business like I am, where you have to be very, very disciplined on how you use your resources and cost, that makes you a better business when the upswing comes, and the upswing will come.
Anthony, thank you so much for joining us. Anthony Jenkins there, chairman and founder of 10x Banking, on a conversation, of course, on the UK and on fintech. Coming up, it's a big week for central banks with the Fed's meeting taking center stage. The BOE and ECB decisions also on the agenda. So we'll have plenty more on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Let's take a look at some of the other events we're following this week. Today, ECB Governing Council member François Villeroy de Galhau is due to speak at an event in Paris. Tomorrow, UBS and UniCredit report earnings. We'll also have the U.S. Employment Cost Index. On Wednesday, it's Fed rate decision, ISM manufacturing and jobs data also due out. That's followed by rate decisions from the ECB and BOE on Thursday. Also, big day for tech earnings. Alphabet, Apple, Amazon and Qualcomm are reporting. And then on Friday, it's U.S. unemployment and non-farm payrolls. This is the picture for the markets. A lot of the focus not only on what's happening in Spain, that inflation print, but the Adani rout hitting some $72 billion as the fight with Hindenburg is intensifying. So let's look at some of, first of all, the bond yields that are moving. Two things that we found out this morning. First of all, inflation in Spain unexpectedly jumped. This is boosting rate bets for the ECB, and also Germany may still see a recession after that fourth quarter contraction. So we're seeing a big move, or a move, maybe not a big move, but a move for the 10-year yield in the US, in Germany, and the UK. The other stories that we're watching, three stocks. Unilever picking the Dutch dairy boss as chief executive after a tangle with investors, including Nelson Peltz. After the appointment of a new chief executive, Unilever gaining 0.7%. Renault also agreeing to lower Nissan's stake in the historic rebalancing, down 2.8%. And we're also seeing some changes at Shell. The stock pretty much unchanged. The Bloomberg Surveillance early edition continues in the next hour. Matt Miller and Kailey Leinz in New York, and Edwards here in London. And this is Bloomberg.
I don't think this is a time to be taking possibilities of rate hikes off the table. At the same time, I don't think it's a time to be committing to rate hikes.
I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish.
I just don't see them stopping or pausing anytime soon.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Stocks and futures fall as investors wait to see what the Fed, ECB, and BOE do this week. An unexpected jump in Spanish inflation boosts ECB rate bets. The Adani sell-off gets worse. Companies controlled by Asia's richest person have now lost $72 billion in market value since the short seller accused the businesses of fraud. And Renault has agreed to lower its stake in Nissan. It's a move aimed at ending a source of friction between the two automakers as the industry prepares for historic change. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it seems this Monday, investors losing their nerve a little bit as we head into a really busy week when it comes to rate decisions.
Rate decisions and mega cap earnings as well. So there is going to be a lot for markets to digest. And as you say, Anna, we are not starting the week off on a very positive footing. Of course, this is also the week that China has reopened after a week-long break for the Lunar New Year holiday. And Chinese stocks were higher on the day, but they really lost a lot of ground as the session went on. Opened up about 2% higher. By the end of the day, we were right around session lows with a gain of less than 0.5% on the CSI 300. And Chinese technology stocks in particular were really weak in Hong Kong. The Hang Seng Tech Index down about 5%, which was its worst day going back several months to October of last year. And of course, since the lows in October of last year, this is an index that has rallied more than 70%, at least before today. So we gave back some of that really remarkable rally, maybe a little bit of profit taking, or investors expecting that the peak for these names may already be in. Then, of course, the other story we continue to follow in the stock space in Asia is in India, specifically with Adani Group stocks. Adani over the weekend publishing a rebuttal that was more than 400 pages long, pushing back against the claims made by Hindenburg last week, saying they were an attack against India itself. It's interesting to see this playing out in the market today. The enterprise Adani Group stock is up nearly 5%, so a bit of a rebound happening there, but some of the other related firms are still down quite heavily, like Adani Total Gas, down another 20% on this Monday after a 20% drop on Friday. Matt, when you put it all together collectively over the last 3 days, we have seen about $70 billion in market value wiped out of Adani's firms.
Yeah, and I think everyone's been paying very close attention. This is a fascinating saga for us to follow in markets. In terms of U.S. markets, we see futures down pretty substantially this morning, off 0.9%. Okay, we had a positive cash close on Friday, up above 4,000. I think 4,070 is the level we hit on Friday, but we're coming down heading into this very busy week of central bank decisions, economic data points, also going to be weighing on markets if they come in wrong. U.S. 10-year yield rising about 3 basis points as investors sell that debt. 353 is the level we're looking at right now on the 10-year. And NYMEX crude comes back down under $80 a barrel. So we see that move down for West Texas Intermediate to $79.27. Bitcoin is down right now 2.7%. So that looks fairly substantial. But we have to remember that Bitcoin trades 24/7. So it's down from a high that it hit yesterday evening of almost $24,000. It's still up from the Friday close. Anna, what do you see in Europe?
Well, here in Europe, Matt, one of the worst performing sectors is around technology. And this really links back to the Asia session as China mainland traders come back to their desks after the Lunar New Year holiday, selling some of the names that have done well recently. So Chinese tech was down, Hong Kong tech down in particular. That weighed on Tencent, which therefore weighs on Prosus. You can see the AEX is down by 1.2%, and Prosus is one of the big movers on that market because it has a big stake in the games maker and other things over in the Chinese market that is Tencent. Here we're focused on the macro, though, as Kailey and Matt were both pointing out, a big week in terms of the inflation story, the fight against inflation. Central banks around the world is still in hiking mode, even if at slightly reduced levels in some cases. But we start the week with a warning about what's at stake here in terms of inflation. More on this from our colleague Maria Tadeo in just a moment, but 109.07, so a jump in the euro as a result of that higher than expected inflation print coming through in Spain. On to some corporate earnings stories. Philips numbers coming in well well ahead of estimates, much better than had been anticipated. Also some job cuts in the mix there from the Dutch medical devices maker, down by 5.8%. Unilever, a change at the helm of this Dutch business, Anglo-Dutch business, up by 0.7%. The new guy who they brought in, he's been on the board for a little while, but essentially an external appointment, Hein Schumacher, not very well known to analysts, it seems, but everyone giving him the benefit of the doubt. He only takes over in July. And Renault in focus. Again, we'll get more on this in just a moment. That stock down by 2.5% as they reduce their stake in Nissan. This story goes back a long way, but analysts looking forwards are asking what this really means for the actual on-the-ground relationship between these alliance buddies in this business. So we'll certainly get more details on that in a moment. Now, Bloomberg's Maria Tadeo joins us from Brussels to take us through some of the inflation narrative. Maria, Spanish inflation then surprising to the upside. We expected a drop down from something with a 5 handle to something with a 4. Instead, we got a jump up. What does this mean, this warning for the broader euro area?
Yes, Anna, and look, today I come in particularly handy because on Thursday I'll be, of course, at the European Central Bank. It's their decision happening that day, but also this is Spanish inflation. This is a number that I used to cover for years when I was a print reporter, and I think to me there's two things that really we should highlight on this. First of all, you mentioned it. It's a 5.8 acceleration in inflation in January. The expectation was that we would see a cool down in January. That is not the case. When you look at core inflation, that is also persistent and sticky. And to answer your question, what does it mean for the euro area? A lot of market players really like to look at Spain as a forward-looking indicator for the rest of the Eurozone. And I think right now, when you hope, or if you were hoping for a peak inflation story, well, today, clearly, you're not getting one. In fact, it's the opposite. It's an acceleration in pricing.
So, Maria, from the days of, you as a cub reporter in Madrid to now covering all of Europe for us, out of Brussels, out of Frankfurt, I guess later this week. What does it mean for the ECB? Because we've been hearing so many voices, so many hawkish voices. They seem louder than the doves saying, stay the course.
Yeah, in particular for me, it means a lot more work and a lot less sleep. But what really matters is the European Central Bank. Look, Matt, I think when you look at Thursday, everyone that I speak to, every economist, every ECB watcher says it's 50 basis points. No question. They have no choice. Essentially, the market has been so well guided to it that not doing that would be a communications disaster. Plus, you have the data coming in today. I think the real debate is about March. Will they hint in that press conference at another 50 basis points hike, or will there be nuance in the language? Some were expecting that there could be because the data had been better than expected in December over the Christmas break. But of course, when you look at the inflation number today from Spain, that could, or you could argue, will embolden the hawks to say, we're not done. This is hit and stay the course.
All right, Bloomberg's Maria Tadeo, looking forward to your reporting on the ECB later on this week. Meanwhile, let's get back to the story in India. Billionaire Gautam Adani's attempt to restore confidence in his business empire is falling flat with investors. Shares of most Adani Group firms are slumping again today. The sell-off has now erased about $72 billion in market value. Bloomberg's PR Sanjay joins us now from Mumbai with more. So, PR, it doesn't seem that 400-something page rebuttal really worked.
413 pages to be precise, and of 88 questions posed by Hindenburg, Adani said 68 refers to the matter has been already disclosed to the public, and out of 20, 16 refers to public shareholders and source of funds, and 4 they said it's simply baseless. And the last part was very interesting. That this report is not against Adani but against India, to mislead the global investors against India growth story. So, but these rebuttals, the 430 pages rebuttal, could not help Adani to arrest the erosion of market wealth. They've lost 72 billion, and some of the companies have, of course, gained a bit, but most of the group companies erased the gains and back in red.
What happens next, then, on this saga, do we think? Because, I mean, we've heard from Adani with this many, many pages of rebuttal, as you say. Hindenburg says this doesn't answer our questions, and investors continue to sell the stock.
Oh, that's an interesting question. Tomorrow is the last day, a D-Day for if the follow-on issue, which is seeking to raise $2.5 billion. We spoke to Adani sources and CFO. They're saying that still there is a huge interest from HNI, high net worth individuals. And once they put in money tomorrow, retail investors will be back, and they are very hopeful about to conclude this follow-on issue successfully. Let's wait and watch. It's a developing story.
PR, thanks so much for your continued coverage. Bloomberg's PR Sanjay reporting live from Mumbai on the Adani saga. Now let's get to another one involving French and Japanese car makers. Renault has agreed to lower its stake in Nissan to 15%. The move equalizes their cross-shareholding partnerships in a revamped alliance. Joining us now from Paris is Bloomberg French transport reporter Albertina Torsoli. So, Albertina, after months of drama, years really, we're finally nearing an historic agreement between Renault and Nissan. But Renault shares are down. Why is that?
Yes, finally there, but not yet there. The two board meetings will take place in the coming days and still need to approve this historic deal between two companies that had really many troubled years. As you point out, everyone will remember the spectacular downfall of then Alliance leader Carlos Ghosn. Today's step is a positive one, but really confirms what Bloomberg had reported January 26 on agreement at top level having been found. But we are missing all the details. There's one detail in particular that is missing, and as you well know, God is in the detail. How much Nissan is willing to invest in Ampere. All this is happening because Renault and Nissan need to move on with their strategy. In particular, Renault is splitting up its business in 5 units. Ampere is the future, really, of Renault. It's its electric vehicle business, and Nissan will back it, but there's been a lot of months of discussion on valuation of Ampere, how much Nissan will invest, and of course Ampere will be IPO'd one day. You really need your alliance buddy, as you call them, to back you up on that, and we still don't have that information. That's the disappointment
absolutely.
Today.
So, Albertina, so we look ahead to see if we find that, see what we find in the detail, the devil or otherwise. Give us some more details of what the next steps will be then here, because, yes, some analysts are saying that this is the crucial piece of the data puzzle, or the puzzle that is now missing, just what kind of involvement they'll have in the new EV business.
Yes, we are expecting the boards of the respective companies to meet in coming days. I don't think there will be particularly any issues Renault side, but Nissan, Nissan, some people at Nissan, some executives haven't been totally convinced by this plan. We have gotten to a good place today. The independent directors of the company gave a nod on January 17, but the contract has to be signed. As soon as that is signed, there will be, from what our sources are telling us, a meeting in London, an alliance meeting in London, expected February 6th, so next Monday, a week from now. Everyone will be flying into London to, pitch this new deal to investors. But until then, we have to hang on and wait.
All right, we'll wait and see how that goes next week or the week after. Math is hard on a Monday morning. Bloomberg's Albertina Torsoli reporting from Paris. Thank you so much. Now let's get back to some stocks moving here in the U.S. We're watching in pre-market trading. There's a few groups I want to point out, one of them being Chinese technology stocks. As Anna and I both mentioned, it was a really weak session overnight in Asia. And so the U.S. ADRs are really following that in the pre-market session here stateside this morning. Alibaba's ADR is down about 6%. JD.com down about 5%. Bilibili down about 7.5%. You're seeing weakness elsewhere in tech as well, including in the semiconductor space. Remember, we're getting more reports from some of these names like AMD. That will be reporting tomorrow. It's down about 1.6% today. Ahead of that, NVIDIA down about 2.4%. And Intel, after a 6% loss on Friday, after it gave a disappointing outlook, really quite terrible outlook, is down again, down about 2% before the bell. Then when it comes to some of those larger cap tech names, you're seeing weakness there too, including for Tesla, which rallied 33% last week. Its best week since 2013 after it reported results, but giving back some of that gain, down about 1.5%. And you have Amazon and Apple each down more than 1% as well. Of course, we're waiting for their results later this week, Anna.
Yeah, absolutely incredible moves on Tesla, incredible moves on the Nasdaq really last week, really catching up with some of the other outperformers of 2023. Coming up, Ben Gutteridge joins us. He'll give us his perspective on the year-to-date market performance. Invesco Asset Management Director of Portfolio Services. He'll be with us shortly. And Wall Street is losing out to the amateurs, it seems, in the US real estate slump. Read more of today's big take story online or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York at Kailey, Leinz, Anna Edwards with us out of London. And it is Fed week. So we're looking at market pricing right now for a terminal rate, an effective terminal rate of 4.9%. That really translates into an upper bound of 5%. The Fed has forecast its own terminal rate with an upper bound of 5.25%, or an effective rate of like 5.10, 5.17. In any case, it looks like the market doesn't think the Fed can actually get there. Joining us to talk about this is Ven Rom, Bloomberg cross-asset strategist. Ven, I guess give us your preview of what to expect from the meeting and the decision on Wednesday, and why do you think the market continues to push back?
Morning, Matt. I think that everyone's expecting a 25 basis point increase at this point, and I think that's what we will get from the Fed on Wednesday. I think that what will be the key to the markets is the messaging from the Fed, and I don't think Powell is going to quite say, yes, there is no need to take rates to 5.25 as our dot plot showed, simply because there's too much uncertainty about the path of inflation. Yes, we have seen inflation moderate, but at current levels, inflation is still way more elevated than it needs to be. It's nowhere near the 2% target. And that's what Powell will hammer home on Wednesday. And that fact is kind of lost on the markets. The markets are looking at the economy. Yes, we already know that the economy is going to weaken, is going to soften, and that is what it is doing. And the Fed has that in the back of its mind, but it's not going to recant its strategy just yet for the reasons I mentioned, because inflation... Sorry.
Yeah, I was just going to say, so yes, we'll wait to see what the narrative is, what the story is that the Fed tells, Ben, as you were setting out there. Let me ask you about the ECB, because we're going to hear from the ECB as well. The euro jumping on that higher than expected, hotter than expected Spanish inflation data. Does this have broader read across, do you think, Ben?
Absolutely. I think that, we have been hearing pretty much from all the ECB officials in the past 10 days or so, even before this morning's print, saying that, look, rates need to be at much more restrictive levels. And if anything, this morning's Spain's inflation beat suggests that there is little incentive for the hawks on the ECB to say, you know what, we can just do with 150 basis point hike in February and we can go slower at March. I just don't think that's how the script is going to play out. I think the script is going to play out pretty much as President Lagarde said at last month's meeting, which is that we need back-to-back rate increases of 50 basis points. So my own thinking is that we are going to get 50 basis points on Wednesday, 50 basis points in March, and 2 more increases of 25 basis points each by June to get us to the 3.5% terminal rate by the end of the summer.
Ben, thanks very much. Bloomberg's Ben Ram from the Markets Live team with the latest on what to expect. It is a really busy week. The Fed, the ECB, also the Bank of England, of course. For more market analysis, check out MLIV Go. They'll be all across the Fed, of course, the big event of the week in the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. In Iran, authorities say that a drone attack caused a heavy explosion at a Defense Ministry ammunition depot. The attack happened in the city of Isfahan. According to the Wall Street Journal, Israel carried out the strike. The journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. President Biden will meet with House Speaker Kevin McCarthy on Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending cuts. The president has refused to negotiate over the debt limit. Turkey's President Recep Tayyip Erdogan may back Finland's bid to join NATO while rejecting Sweden. Erdogan told state-run TV that Sweden will be shocked when Turkey gives its response. Turkey has balked at ratifying Sweden's bid over its hesitance to crack down on supporters of Kurdish militants. And it will be the Kansas City Chiefs versus the Philadelphia Eagles in the Super Bowl. The Chiefs beat the Cincinnati Bengals 23-20 with a last-second field goal to win the AFC Championship. Meanwhile, the Eagles pounded San Francisco 31-7 in the NFC title game. The Super Bowl is set for February 12th in Glendale, Arizona. And Matt, I think I'm on Team Chiefs now because I was Team Bengals, but I'm definitely not Team Eagles.
Yeah, well, I'm also not for the birds, and I don't really care that much about pros versus college football, but they really have to institute Sky Judge because so many bad calls against Cincinnati makes it look like the league doesn't want the Bengals to win.
Okay, I'll be keeping it entirely neutral, and we'll get back to the markets conversation shortly. Ben Gutteridge joins us, Invesco Asset Management Director of Model Portfolio Services, ahead of a big week for central banks and earnings. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Stocks and futures fall as investors wait to see what the Fed, ECB and Bank of England do this week. An unexpected jump in Spanish inflation boosts ECB rate bets. The Adani sell-off gets worse. Companies controlled by Asia's richest person have now lost $72 billion in market value since a short seller accused the business of fraud. And Renault has agreed to lower its stake in Nissan. It's a move aimed at ending a source of friction between the two automakers as the industry prepares for historic change. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, it's hard to overstate the importance of this week in terms of the central bank meetings that are taking place. Of course, the Fed central to all of that, plus the earnings stories, big tech names in focus later in the week.
Yeah, absolutely. We're going to get to the big earnings stories, but I think right now the market really is focused on the Fed narrative, and it's not just the ECB that is highlighted by Spanish inflation, the resurgence there. I guess resurgence is a strong word. Maybe the beat. I think it looks like U.S. investors realize that could happen here as well. And that's one of the reasons that S&P futures are down 0.9%. It's a pretty significant move to the downside. But also, it shows us just how high we finished in the cash trade on Friday. We were up at 4,070. And for a lot of strategists, that's already their year-end target. We haven't gotten to the end of the first month of the year yet. The U.S. 10-year yield right now rising more than 3.5 basis points as investors sell that debt. So 354.21 is the number going out 5 significant digits. You also see NYMEX crude coming down under $80 a barrel. So West Texas Intermediate trading at 79.22, and a lot of red on the screen. Bitcoin is off. But I should note, this is from yesterday's close, or really from, I guess, midnight last night. Bitcoin hit almost $24,000 in price at the end of Sunday trading, and now it's down, but to a higher level than we saw on Friday at 23,273. Kailey, what do you see in terms of pre-market movers?
Well, on the note of Bitcoin being lower, you are seeing that reading through to some of those crypto-related equities and pre-market trading like Coinbase, the big public exchange. It's down about 3.5%. But really, there's just weakness across all varying parts of the technology sector this morning. That's really what's leading the losses for futures, including for Tesla, down about 0.9%. So giving back some of the really remarkable gains from last week. Remember, last week up 33%, the best weekly performance going back to 2013. Then we have, as you said, more earnings are coming later on this week, including more from the chip space. AMD will be reporting tomorrow. It's down about 1.6% to start the week, and some weakness for those big Chinese technology names as well. We saw that in Asia overnight. It is continuing with the ADRs here in the U.S. Alibaba, for example, down the better part of 6% before the bell, Anna.
Kailey, here in Europe, then we see overall weakness for European stocks, down by 0.7% on today's session as we head towards the end of the month of January. Of course, the technology sector is in focus here in Europe, considerably weaker than it was. But a lot of that has to do with Prosus, which has a big holding in Tencent over in China. And as a result of the weakness in the Hong Kong listing of that business, we see that Prosus is weaker in that ways. But many sectors in Europe are in negative territory, as you'd expect when we're down quite substantially. This is the euro, though, 109.10, so not down on the euro. The euro it jumps. That's on the back of that Spanish inflation print. We had expected the inflation print to retreat from a 5 handle to a 4 handle in terms of that year-on-year move, but it didn't do that. In fact, we got a jump, a higher reading on Spanish inflation, and so that really puts the ECB in focus this week. We had already expected a 50 basis point move, so maybe the narrative moves to the following month. Will we get something similar? Philips is up by 7.4%, and this is a business that delivered some numbers that backward-looking really beat expectations, but also decided to announce some hefty job cuts. And we've seen with big tech over in the United States that those job cut stories, that focus on the cost base has gone down, at least in the short term, quite positively with investors. And this is Renault down by 1.7%. The car maker coming to another agreement when it comes to its alliance with Nissan and reducing its stake in Nissan, albeit slowly, putting some of it in a trust, and then they'll sell it when the commercial terms seem favourable. So that's what's happening there. But a lot of questions still, Kailey, to be answered about the exact working relationship and an investment still to be made by Nissan into Renault. A lot of those questions still unanswered.
Yeah, and we'll be looking for those answers over the coming weeks, Anna. Meanwhile, we do have some breaking news to mention. Russia is planning to increase its diesel exports in February, despite Europe's ban on those exports. Russia is planning seaborne diesel exports at 2.74 million tons, so it'll be interesting to see who exactly the buyers are of those upped exports. And of course, all of this factoring into the energy conversation for Europe and the world more broadly, and the inflation narrative, something central banks have continued to weigh and will do so again when they make decisions this week. Joining us now to discuss further is Ben Gutteridge, Invesco Asset Management Director of Model Portfolio Services. Ben, good to see you. Thank you so much for being with us. If we could just begin with the Fed on Wednesday. 25 basis points seems like it's baked in. How hawkish could a 25 basis point hike be?
Well, yeah, you're right. It does seem pretty baked in. So it's sort of the communications about policy thereafter. You know, I think the market or the investment community is sort of inclined to believe there'll only be sort of one more hike before there is sort of a pause, a moment of reflection to see how all those hikes that have come prior impact the economy. But if there is, you know, a higher for longer interest rate communication, or, you know, that there could be, you know, a third or two successive quarter point hikes, you know, markets probably wouldn't like that.
Yeah, markets might not. And I suppose, are you focused then, Ben, on the extent to which inflation has come down from its highs, or the extent to which inflation might linger at these still relatively elevated levels versus recent history? Because that might dictate how the Fed leans in its narrative.
Yeah, that's right. Yeah, I mean, I think to answer the question, we'd be more inclined to favour the fading inflation or the moderating inflationary pressures, which would allow the Federal Reserve to deliver this and then one more rate hike. And I think markets, in conjunction with, you know, moderating inflation, slightly less hawkish central banks and slightly better growth stories globally, that would allow equity markets to perform. But on that basis, if it is a higher for longer interest rate story, inflationary surprises to the upside, you know, our positioning might be caught a little offside with that.
Right, and in that context, you do prefer US equities. Is that based on some of the things you just described there? I mean, US equities have been struggling to catch up, although I note that the Nasdaq's been doing quite a good job of catching up with European stocks year to date.
Yeah, it's been a good year for the Nasdaq, isn't it, after a terrible year last year. But, yeah, look, I think there is a bit of sort of portfolio and risk management in this. You know, I think we're broadly quite positive about equities. I think US has a little bit of catch-up after sort of Europe's strength. There's also sort of a duration bit in there. You know, if inflation pressures fade, perhaps longer bond yields could fall. That's sort of good for the longer-term earnings story of US companies. But look, I think there is some momentum here for Europe on the back of its own sort of fading energy challenges and, of course, China reopening. So in the short term, you know, there is symmetric risk there. But I think on balance over the medium term, we prefer US equities.
What industries do you like in the U.S., Ben, in terms of what we've seen happen so far year to date? As Anna mentioned, tech stocks have done a lot better. The defensive stocks have done really badly year to date. Consumer staples, utilities, healthcare, all down.
Yeah, I mean, I think we would, by favouring US equities, I think we'd have to put our hands up that the broadly defined tech universe is going to be something that we would be sort of implicitly supporting. You know, clearly in the short term, what they're doing with relation to cost management is an improving story, and the bond yield element that I've talked about could help. But to the flip side of that, I think, you know, sort of the barbell of technology, we look to the energy sector, you know, the oil markets, I don't think really reflecting what's happening in relation to the sort of Chinese reopening story. Like lots of parts of the markets have moved quite quickly on that, haven't they? But the oil price certainly hasn't, and we think that could support the energy sector.
Yeah, exactly where I was going to go, Ben. I think it's fascinating when you look at the breakdown of industry groups on the S&P 500, that tech's done well, that the defensive stocks have done poorly. Energy's right there in the middle of the group. And with the Chinese reopening, you've got to ask yourself, are we going to see a surge in demand for things like oil, iron ore, copper? What do you think about commodities?
Well, I think there is a greater probability of a surge in demand for energy, for oil. And we think the sort of reopening story is more of a sort of a domestic recovery, and is less inclined to see sort of a sucking in of imports all around the world. I think, you know, of course, there's many parts to it, but, you know, going to the cinema more, going to the restaurants more, travelling more, you know, I think this is more of an energy story or an underappreciated energy recovery story than perhaps, you know, commodities and aggregate sort of metals at large. So would favour, as I said, favour the energy sector above sort of mining in that regard.
Is it possible that the oil market is just at this point pricing in a greater risk of global recession than other risk assets, Ben? And is that appropriate?
Yeah, I think that would have to explain it, that the energy markets are weaker on the back of this China story, is that the greater concern is the prospect of a US recession, of a downturn in the global economy. We're not expecting like a marked tick up in the global economic conditions and outcomes, but we see sort of an ameliorating story, perhaps better than those sort of negative expectations. You know, as I said, China reopening, Europe energy complex boosting real incomes in Europe, you know, US inflation fading, that's better for real incomes there. We think on that basis, perhaps the growth outcome isn't as bad as anticipated, coupled with the China reopening. You know, perhaps the oil price is a little bit underappreciated at the moment.
OK, and Ben, thinking about other asset classes, investment-grade debt, are we in a bit of a sweet spot there, given the sort of risk and reward, as we wait to see how the US economy plays out?
Well, I think on balance, we would be favouring corporate credit. I think the risks are still quite symmetric. You know, I have painted a relatively positive picture here, but, you know, there is... I could be wrong. There is precedence of that, and you know, this hawkish. If we get that hawkish surprises from the central bank, inflation stickier than anticipated, and a more marked downturn, you know, it's unlikely corporate bonds are going to do particularly well. But on balance, if we think about a mild recession or a soft landing, if you're allowed to use those terms, then corporate credit looks pretty well placed, I think.
You're allowed to use those terms.
OK. Yeah, I guess I'm not that important.
Anybody can use those terms. Ben, thank you very much. Ben Gutteridge joining us there from Invesco. Coming up on the programme, opening Pandora's box, how Hindenburg's report on Adani may be a wake-up call to global investors on India. Interesting timing of this whole conversation on India in relation to its role in the global economy. We'll discuss that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Nobel Prize-winning economist Paul Krugman. That's at 12 p.m. New York time, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, the billionaire Gautam Adani's attempt to restore confidence in his business empire is falling flat with investors. The sell-off of Adani Group firms has now erased about $72 billion in market value. Shuli Ren joins us, Bloomberg opinion columnist. She's in Hong Kong. Her latest column explores how Hindenburg's report is a wake-up call, she believes, to global investors on India and across emerging markets more broadly. Shuli, take us from the micro then to this sort of bigger picture story. What is it that you think is important about the way that this story is playing out for investors who are focused maybe not on Adani but on other Indian companies or indeed emerging markets more broadly?
So the Adani report is coming out at a very interesting time. last year, we know what happened to China, COVID-0, all the developer crackdowns, the deepest recession since the Cultural Revolution. So global investors, they basically de-risked and sold off their Chinese stocks, and they were ready to go somewhere else. And India was a natural destination, right? Like, they also have a population of 1.4 billion with younger population and brighter prospects. And whatever you say about Prime Minister Narendra Modi, he did clean up India and he's pro-growth. But what happened was that the Indian stock market is notoriously expensive. It's trading at over 20 times earnings ratio. And the global investors didn't really ask many questions. They basically just bought in because they wanted to escape from China. And the Hindenburg report basically said, wait a minute, Indian companies are not as clean as you thought. I mean, they also have corporate governance issues, and all their allegations sound very, very familiar, eerily familiar to China's HNA or China Evergrande Group, right? So the question becomes, is India worth the equity premium that the investors have bought into?
Julie, the rebuttal by the Adani Group to Hindenburg says that Hindenburg is really attacking India itself and almost, exploiting racist tropes. It's, I think, a great defense because it kind of takes your eye off the ball. But is it fair?
Well, the timing is very interesting. I mean, it was released just at the time when India was celebrating its Republic Day. So it's very easy to whip up that kind of nationalist sentiment, right? I think in a way, the way emerging markets work, in a way, it could be considered fairly fair because with emerging markets, we know corporate governance is not an issue. Adani is willing to play Modi's aggressive industrial policy, and he is trying to build India's roads, ports, airports, green hydrogen, what you call it. Of course, the corporate governance issue is kind of brushed aside, not unlike what happened to South Korea at the chaebols.
Okay, so there's interesting politics at play here, given how closely aligned Adani is with Modi. So what does that mean for the long-term potential success of Hindenburg's campaign?
I think it's Hindenburg is very well regarding the New York's finance circle. Its founder had to work with the analysts who uncovered Bernie Madoff's biggest Ponzi scheme in the world. But it's no guarantee if we look at what happened in emerging Asia that a prominent short seller in New York can repeat his success in Asia. I mean, what happened with HNA, with China Evergrande? They had been harassed in a way by short sellers for years without much catalyst, to be honest. And these companies only fail when there was a changing political wind. HNA failed in 2017 because the Chinese government was coming after private companies that were doing a lot of overseas deals. Evergrande fell in 2021 because China was cracking down on real estate developers. So I think the question at this point, there are two questions. Number one is Modi government going to distance itself from Adani? Number two is this short seller report going to shut down Adani's refinancing channels?
Yes, and that's a very active question, isn't it, given what they're trying to do at the moment over at these Adani businesses. Is there anything that Adani themselves can do then to try and stop the rot in the share price? I mean, they put out more than 400 pages of explanation trying to rebut what Hindenburg has been saying, but the market continues to sell the stocks.
Well, I think if you believe Hindenburg's allegations, I mean, all the outstanding floats of the flagship Adani Enterprises is owned by the Adani insiders, right? If they want to do share price management, they can very well do that. But I think one thing they could do is to, perhaps just let the New York fund make some money and go away, unfortunately.
Julie, thank you very much. Thanks for bringing us your opinion. Julie Wren from Bloomberg Opinion with the latest on the Adani saga. Coming up on the programme, it is a big week for central banks, as we've said a few times. We will run you through the key events that you need to be aware of. That's coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is coming up for the rest of the week. Tomorrow, that's Tuesday, UBS and UniCredit will kick off European bank earnings. Then on Wednesday, it's the big one, the Fed's rate decision. Officials are poised to slow the pace of rate hikes for a second straight meeting with just a 25 basis point move. Plus, ISM manufacturing and JOLTS data are also out on Wednesday. That's followed by rate decisions from both the ECB and BOE on Thursday, which is also a big day for tech earnings. Alphabet, Apple, Amazon, and Qualcomm all will be reporting. And then on Friday, it is the jobs report here in the U.S. Of course, Matt, the focus going to be on average hourly wage ratings, and Anna, as well as the non-farm payrolls print. Right now, the average economist estimate 185,000.
Yeah, certainly a lot going on this week. The list of central bank events, the corporate earnings story, there's just plenty in the mix, isn't there? Now, the U.S. Treasury Secretary Janet Yellen says she's encouraged by recent U.S. data on inflation and jobs. We'll get more on that this week, but conceded the economy is at risk of recession amid high interest rates. She spoke exclusively to Bloomberg's Chris Condon in Johannesburg in South Africa.
I don't want to minimize the risk of recession in the absence of further, shocks. It really comes down to the labor market. And I guess the path that I see to maintaining a strong labor market while bringing inflation down does involve a slowdown in growth.
Yeah, really interesting conversation there about the labour market. And of course, Matt, that is going to be front and centre once again this week as we work our way towards the Fed and then that non-farm payrolls number on Friday. To what extent is it going to be possible to bring down aggregate demand in the economy whilst at the same time not doing too much, but doing enough damage to the labour market to make it less tight, to weigh down on wage pressures? All of that very much a live conversation still into 2023.
Yeah, it does seem like there's still a lot of optimism for a soft landing, as Ben Gutteridge just said, and as you allowed him. We can all use that terminology. But the question is, will we have a job-full recession? Will we have any recession at all? I think we need to continue being reminded that there are long and varied lags of Fed policy, because it just seems too hard to imagine that this could come back and bite us, especially when we get a printout on inflation like we saw in Spain. That could happen anywhere, and I think that's an important reminder as well.
Yeah, it's a question of if the Fed doesn't go far enough to get inflation down to target, could we see a resurgence of it if the economy stays too strong, if the labor market remains too tight? I think that is the concern. Chairman Powell doesn't want a repeat of 1980, right? That is kind of the legacy he's trying to fight against. So I'm really interested to see how hawkish realistically a 25 basis point hike on Wednesday could be. And if it's all about March and whether or not another hike or a pause comes in that month, the jobs report on Friday is going to be really crucial in the formulation of that expectation.
Yes. It seems that a lot of the focus actually is going to be not just on the short-term decisions around policy, and this applies to the ECB or the Fed or the Bank of England, but actually the second half of the year and how much bond markets and investors start to reprice their expectations for the second half of the year based on this week's events. We'll certainly get into those conversations as we go through this week. That is it for Early Edition. Surveillance is up ahead. They'll be speaking to the head of US economics at Bank of America Securities. Plenty of other voices, of course, also weighing in. A busy week, as we've said, for central banks. They'll be talking about all of those and the earnings report still to come. This is Bloomberg.